This presentation is for Chapter 5, Cost, Volume, Profit Analysis. In Learning Objective 5, we are going to use CVP analysis to calculate margin of safety, operating leverage, and multi-product break-even points. We have learned how CVP analysis can be used for estimating target profits and break-even points, as well as sensitivity analysis. Three additional applications of CVP analysis are margin of safety, operating leverage, and sales mix. The margin of safety is the excess of expected sales over break-even sales. It is the amount sales can decrease before the company incurs an operating loss. It is the cushion between profit and loss. Managers use the margin of safety to evaluate the risk of both their current operations and their plans for the future. The margin of safety focuses on the sales part of the equation, that is, how many sales dollars the company is generating above break-even sales dollars. We can calculate the margin of safety in units, in dollars, or as a ratio. So using SmartTouch Learning as an example, if the manager's expected sales of 100 tablets and the break-even sales are 60 tablets, the margin of safety in units would be 40 tablets. To calculate the margin of safety in dollars, we take the margin of safety in units, 40 tablets, multiply it by the sales price per unit of $500 per tablet, and we get $20,000 as the margin of safety in dollars. To calculate the margin of safety ratio, we take the margin of safety in units, 40 tablets, and divide it by the expected sales in units of 100 tablets, and we get a margin of safety ratio of 40%. Companies can predict the expected change in operating income due to a change in sales volume based on their cost structure. Operating leverage predicts the effects that fixed costs will have on changes in operating income when sales volume changes. The degree of operating leverage is the ratio that measures the effects that fixed costs have on changes in operating income when sales volume changes. It is found using the following formula. Operating leverage is equal to contribution margin divided by operating income. So for this example, we are going to use two companies that provide horse-drawn carriage tours in Charleston, South Carolina. It is a very competitive business, and both companies charge $25 per person for the tours. Both companies expect to provide tours to 500 passengers during September. Company A has low variable costs and high fixed costs. Company B has the opposite cost structure, high variable cost and low fixed cost. Notice that both companies expect to earn an operating profit of $4,000 if they have 500 passengers during the month. Now let's say that during September a hurricane threatened the area and many tourists made other travel plans. Both companies had only 400 passengers during the month. Although both companies experienced the same decrease in sales volume, Company B's operating income did not decrease as much as Company A's because of its cost structure. The degree of operating leverage for Company A is 2.5. This means that the percentage change in operating income will be 2.5 times the percentage change in sales. For Company B, the percentage change in sales will have a lesser effect on operating income at 1.25 times the change. The chart on this slide shows that the degree of operating leverage accurately predicted the effect on operating income when the sales volume changed. Notice that Company A had higher fixed costs and therefore had a greater decrease in profits when the sales decreased. Higher fixed costs create greater risk for the company. When there is a decrease in sales, there is also a decrease in contribution margin to cover the fixed costs and provide operating income. However, a cost structure with high fixed costs does have the opposite effect when sales increase. So let's say that there had been a 20% increase in sales. It would have had a 2.5 times that effect, or a 50% increase in operating income for Company A. Therefore, a sales increase of $2,500 would have resulted in an increase in operating income of $2,000. Most companies sell more than one product. Sales price and variable costs differ for each product, so each product makes a different contribution margin to profits. The same CVP formulas we used earlier can apply to a company with multiple products. To calculate the break-even point for the company, we must compute the weighted average contribution margin of all the company's products. The sales mix provides the weights that make up total product sales. So for this example, we are going to take a fictitious company, Cool Cat Furniture, and we're going to say that they sold 6,000 cat beds and 4,000 scratching posts during the last year. The sales mix of 6,000 beds and 4,000 posts creates a ratio of 6,000 to 10,000 or 60% cat beds and 4,000 to 10,000 or 40% scratching posts. We can convert this to the least common ratio of 3 to 5 cat beds and 2 to 5 scratching posts. So we can say that the sales mix is 3 to 2, or for every 3 cat beds sold, Cool Cat expects to sell 2 scratching posts. Each package would include 5 items, 3 cat beds and 2 scratching posts. So using the sales mix, we can determine the break-even point for Cool Cat for both cat beds and scratching posts. Cool Cat's total fixed costs are $40,000. The cat bed's unit sales price is $44 and the variable cost per bed is $24. The scratching post unit sales price is $100 and the variable cost per post is $30. To compute break-even sales in units for both products, Cool Cat will complete 3 steps. In step 1, we will calculate the weighted average contribution margin per unit. So to do this, we take the contribution margin per unit, $20 for cat beds and $70 for scratching posts, and we multiply those amounts by that sales mix. So the contribution margin or weighted average contribution margin for each of the items would be $60 for cat beds and $104 for scratching posts. We add those two amounts together to get a total of $200, divide it by the total number of units, which is 5, and we get the weighted average contribution margin per unit of $40. Now we can calculate the break-even point in units for the package of products. We take the total fixed cost of $40,000. There is 0 target profit at break-even, and we divide that by the weighted average contribution margin per unit of $40. When we do that, we get the break-even point of 1,000 units. Now we need to calculate the break-even point in units for each product in the sales mix package. We're going to multiply the package break-even point in units for each product by the product's proportion of the sales mix. So first, for cat beds, we take the 1,000 break-even units and we multiply it by 3 divided by 5, and we get 600 cat beds. Then we take the same 1,000 units and multiply it by 2 divided by 5 to get 400 scratching posts. Multiplying the 600 cat beds by $44, we get $26,400 for cat beds. Multiplying 400 scratching posts by $100, we get $40,000 for the scratching posts. When we add the two together, the total sales revenue at break-even will be $66,400. We can plug in those break-even units into our contribution margin income statement, and we can see that with 600 cat beds and 400 scratching posts, the company will have operating income of 0. And that shows that that is the correct calculation for break-even units. Now let's say that CoolCat wants to earn a profit of $20,000. We can calculate the required sales in units for that target profit. We take the total fixed cost of $40,000, add the target profit of $20,000, and we divide that $60,000 by $40 per unit, and we get 1,500 units. Then we can determine the number of cat beds and scratching posts by multiplying the break-even units of 1,500 by the sales mix of 3 to 5 and 2 to 5, and we get 900 cat beds and 600 scratching posts. We can plug those number of cat beds and scratching posts back in to the contribution margin income statement, and as you can see, CoolCat would earn an operating profit of $20,000. So managers of retail companies like Best Buy can use data analytics to learn about its sales mix and how sales mix affects the company's profits. So in its 2000 annual report, Best Buy reported the following sales mix percentages and gross profit margins. With more than 1,200 domestic stores and more than $38 billion in domestic sales, Best Buy managers need a way to analyze the large volume of data in order to make informed decisions, especially in their pricing and marketing decisions. So in addition to knowing the total gross profit margin, managers also need to know the gross profit margin by revenue category in order to anticipate how changes in the sales mix might affect the company's overall profits. For example, we can see that the percentage of sales in the appliances revenue category has increased, while the percentage of sales in the services revenue category has decreased. Managers need to know the effect this trend will have on overall profits, and if needed, make adjustments in how the categories are promoted. So once again, data analytics can provide the information needed to make these kinds of decisions. And that is the conclusion of the presentation for Learning Objective 5.